This week in global markets, one theme dominated everything: the escalation and persistence of the US-Israel-Iran conflict. But beyond the headlines, we're seeing deeper structural shifts: trade fragmentation, private credit stress, and a growing tilt towards stagflation across major economies. Let's break it all down, region by region, and more importantly, what it means for markets and portfolios. In the United States, the macro picture is becoming increasingly complex. The long-standing valuation premium in US tech has nearly disappeared, now at its lowest level in 7 years. At the same time, policymakers are preparing for extreme scenarios. The Trump administration is assessing the economic impact of oil, potentially reaching $200 per barrel amid prolonged conflict. Inflation pressures are already building. Import and export prices saw their largest increases since 2022, while PMI data shows business activity slowing to a one-year low. Consumer sentiment has fallen to a 3-month low, and inflation expectations are rising as gasoline prices surge. Yet the labor market remains volatile. Continuing unemployment claims dropped to their lowest level in nearly 2 years. Meanwhile, higher rates are biting. Mortgage rates have climbed to 6.38%, weakening the housing outlook. On the flow side, equity funds saw $37 billion in inflows, driven by temporary optimism around de-escalation. But foreign central bank holdings of US Treasuries have dropped sharply, nearing multi-decade lows. Structurally, risks are building. Private credit stress is emerging, with major firms restricting withdrawals. Tariff-related lawsuits are introducing policy uncertainty into corporate pricing models. The takeaway? The US is balancing volatile employment against rising inflation and shocks to growth, which are a classic late-cycle dynamic. China, meanwhile, is navigating the environment with a more strategic lens. Despite strong export growth, policymakers are emphasizing trade balance and stability, while explicitly rejecting currency devaluation as a competitive tool. The oil shock may actually work in China's favor. There is increasing discussion around settling oil trades in yuan, a shift that could gradually reshape global financial flows. Domestically, China is responding proactively through temporary price controls on refined oil and potential fiscal and tax support if crude prices rise further. Interestingly, this oil shock could mark a turning point in China's inflation cycle, with producer prices potentially exiting deflation after years of decline. On the geopolitical front, China has launched investigations into US trade practices, signaling a shift toward more institutional, legal forms of economic conflict. At the same time, Beijing is loosening capital controls and expanding outbound investment channels, positioning itself for a more multipolar financial system. In Europe, the macro outlook is deteriorating into a stagflationary mix. The OECD has downgraded growth forecasts to just 0.8%, while inflation expectations have been revised higher to 2.6%. The European Central Bank has warned that markets may be underestimating the inflationary impact of the Iran conflict and stands ready to act if energy shocks broaden into systemic inflation. Private sector activity is already slowing, expanding at the weakest pace since last year. On trade, the EU is balancing cooperation and confrontation by advancing trade agreements with the US, Australia, and Mercosur, while Germany maps vulnerabilities in US supply chains. Meanwhile, private credit risks are under scrutiny, with regulators preparing new stress checks on bank exposure. Europe is increasingly caught between the energy shock, trade uncertainties, and fragile growth. In Canada, the macro narrative is turning clearly stagflationary. Economists are raising both inflation and unemployment forecasts, with inflation expected at 2.4% and unemployment rising to 6.7%. The housing market remains a major vulnerability, as noted by OSFI. Up to 150,000 borrowers could struggle to refinance amid falling home prices and higher rates. Policy interventions are also creating unintended consequences. Efforts to cap lending rates have pushed some borrowers toward unregulated payday lenders. On the fiscal side, Canada is ramping up defence spending to meet NATO targets. the highest level relative to GDP since the Cold War era. And politically, even tail risks are emerging, with Alberta's independence movement potentially heading to a ballot. In the UK, policymakers are in wait-and-see mode. The Bank of England held rates steady, but markets are pricing in multiple rate hikes in 2026 due to inflation risks. Housing remains weak. London home prices are falling, and new construction is at its lowest level in over 15 years. Politically, tensions with the US are rising, reflecting broader fractures in global alliances. Japan presents a more balanced, but still fragile, picture. The economy is growing modestly, supported by strong consumption and business investment. However, rising oil prices could push inflation higher, with a 10% increase in crude adding up to 0.3 percentage points to CPI. Encouragingly, wage growth remains strong, supporting the Bank of Japan's path toward gradual rate normalization. Across all regions, three dominant themes emerge: geopolitical inflation shock. Oil, trade routes, and energy prices are driving near-term inflation higher. Structural fragmentation. US-China tensions and EU strategic positioning signal a more divided global system. Stagflation risk. Growth is slowing while inflation remains elevated, limiting central bank flexibility. For investors, the implications are clear. Maintain exposure to safe havens, USD, Treasuries, Swiss franc. Expect volatility in fixed income as term premia rebuild. Focus on inflation protection and selective credit. Diversify across regions benefiting from supply chain shifts. This is a market defined not by broad rallies, but by rotation, dispersion, and geopolitics. The key message this week: the end of the geopolitical shock remains uncertain, based on mixed signals on the different sides. If you found this breakdown useful, subscribe for weekly macro insights, and I'll see you next week.